Today, Bitcoin continues its retreat from its new all-time high. Wall Street groups join consumer advocates to ask for a revision to the Genius Act. And ARK Invest's David Puell weighs in on what's driving crypto prices amid increased interest in crypto treasury strategies. Welcome to CNBC's Crypto World. I'm Brandon Gomez. Cryptocurrencies moving lower as we head into the weekend. As of noon Eastern, Bitcoin continued its retreat from its all-time high, now trading at the $117,000 level. Ether fell to the $4,400 level, and XRP dropped to $3.03. Now, despite losses in the past 2 days, both Ether and Bitcoin were in the green for the week, on pace for back-to-back weekly gains. At midday, Bitcoin had risen a little more than 0.5% since last Friday, while Ether gained more than 9%. XRP is in the red for the week, though, down more than 8%, and on pace for its third weekly loss in the past 4. Okay, let's talk about the top stories for the week. Citigroup is looking to offer crypto-related services. Now, the bank's CEO did say in last month's earnings call that Citi was considering the issuance of a stablecoin. Now, an executive from the firm says it could go beyond that. Responding to a Reuters report that the bank was looking into more crypto services, Citi's global head of partnerships and innovations, Biswar Chatterjee, told CNBC, quote, "As part of our commitment to meeting the evolving needs of our clients, we are actively exploring custodial solutions, as well as other stablecoin initiatives, such as reserve management and the potential issuance of our own external token or coin, with safety and soundness top of mind." A digital asset custody platform would put Citi in competition with firms like Coinbase and BitGo, and the issuance of a stablecoin could turbocharge payments for the bank. Currently, the bank operates Citi Token Services, which offers 24/7 instant payments, but only to certain Citi branches. Since President Trump signed the Genius Act stablecoin regulation bill into law last month, Wall Street has ramped up plans to operate in the crypto space. Bank of America has also expressed interest in launching a stablecoin, and even JP Morgan CEO Jamie Dimon, a staunch critic of cryptocurrencies, said last month in an earnings call that his firm will be involved in stablecoins. On the flip side, some Wall Street advocate groups are pushing Congress to roll back some of the Genius Act. This week, a group of banking lobbyists joined consumer advocates, writing a letter to a bipartisan group of senators and asking them to revise Section 16D of the stablecoin legislation. Now, that provision says uninsured depository institutions that issue stablecoins, aka those not protected by the FDIC, can offer some services across state lines, bypassing state licensing requirements. The letter argues Section 16D upends a system that lets states safeguard their residents from a heightened risk of financial harm if these institutions fail. The groups suggest Congress use market structure legislation to roll back the provision. Last, digital assets firm Galaxy Digital announced it secured $1.4 billion in financing to accelerate development of its AI data center in Texas. Galaxy said the 36-month loan is secured by the assets associated with the first phase of the data center's build-out. Galaxy anticipates the data center will generate $1 billion annually over the course of 15 years in a partnership with AI cloud computing firm CoreWeave. Galaxy Digital is among the digital asset firms pivoting to AI as data center demand explodes. It's also among the slew of crypto firms that went public in the US under the current friendlier towards crypto Congress. Following the announcement, shares of Galaxy dropped more than 8% as of noon. All right, back to the markets for our main story. Bitcoin hit a new record this week above $124,000, and Ether came close to surpassing its all-time high, reached back in 2021. But both cryptocurrencies have since retreated. Earlier this week, Crypto World's Talia Kaplan spoke with David Puell, Associate Portfolio Manager of Digital Assets at ARK Invest, about what has been driving crypto prices and how crypto treasury strategies and spot crypto ETFs factor into the equation.
So August got off to a rocky start for crypto amid weak economic data and tariff-related headlines. But this week, Bitcoin and Ether have been trading near all-time highs. How do you explain what's going on? What's driving crypto prices right now?
So I think everything relates ultimately to Bitcoin's price action. As in most cycles, I don't think this one is an exception. What we've seen in the bull market so far is that Bitcoin has behaved as usual if you track its on-chain analytics, meaning it's inner economics, it's inner supply and demand, which is what we analyze here at ARK. Usually what you see is for a global top on a 4-year cycle to happen, you need about a 2.5 multiple of market price being over the on-chain cost basis of Bitcoin. And right now we're only trading on a 1.5 multiple. So it's a bull market for sure, but not overheated yet.
So do you think this momentum for Bitcoin will continue in the near term? If so, what would it take? And what are some of the catalysts essentially?
The most played out in the media right now is the corporate treasury strategy and adoption across especially US companies. We also see healthy supply and demand in long-term holders, for instance, of Bitcoin, which we track on a live basis. And we also see, unlike prior bull markets, a pretty healthy price action and market structure, which is unusual for a bull market. You always see the parabolic moves way back like in 2017 or 2020. But unlike those years, we're seeing a very robust, healthy, and with brief corrections as opposed to very long-term and aggressive corrections so far. So the expectation on a seasonal basis is usually you see tops the year after the halving year, which is 2025, but that usually happens late in that year. So more of a Q4 factor. So we're cautiously, but optimistic. Cautiously optimistic, but optimistic nonetheless.
Now, a few months ago, ARK released its updated price target for Bitcoin in 2030, projecting bear, base, and bull cases of approximately $300,000, $710,000, and $1.5 million per Bitcoin, respectively. You wrote that institutional investment contributes the most to your bull case, and that nation-state treasuries, corporate treasuries, and Bitcoin's decentralized financial services contribute relatively little in each case. Can you elaborate on that? What was the reasoning behind your updated forecast?
So the update comes from another relatively similar model we launched on 2023, I believe. It didn't deviate from that initial model that much. I think it just goes to show the big divergence that exists between the hype we're seeing today in the corporate treasuries and discounting still the importance of the digital gold narrative and the institutional narrative relative to Bitcoin. Right now, the hype is all about corporate treasuries, but the underlying true demand is happening on an ETF level, on spot level, directly to the asset, on crypto exchanges. So I think that's more of a longer term play that goes into the targets we point out for 2020.
Now, let's focus on ETH because it seems like the cryptocurrency is getting a lot of attention these days. As of midweek, inflows into Ether ETFs are up to $1.5 billion compared to more than $240 million into Bitcoin ETFs. And we're heading for their fourth consecutive week, outpacing flows into Bitcoin ETFs. What does that signal to you, and why do you think that's happening specifically now?
Well, for someone who has been, I've been in the industry full time since 2017, give or take. For someone who has been in a few cycles, this is not atypical. You usually see what in the crypto world is known as the alt season. It was late this cycle, this time around for sure. So that was surprising for people more familiar with the crypto cycle. But it seems to have come nonetheless. I think the main catalyst is again a lot of market actors developing the corporate treasury model for ETH, and quite strategically. That the corporate treasury model has a main differential compared to a Bitcoin only strategy, which is the staking, right? They're allowed to stake 100% of their ETH and get 100% of that yield. Unlike some other products, staking has been one of the main impediments for investing in an ETH ETF. So I think that's one factor. The other factor is just ETH compared to Bitcoin was very oversold. and it's just compensating for that and catching up to Bitcoin after a few years of bull market.
So what are your thoughts on spot crypto ETFs, as many initially poured into these investment vehicles as they were an avenue for people to get access to crypto exposure? But now we're seeing a more crypto-friendly administration and regulators here in the US. And so some think that ETFs might no longer be the way to go, especially in light of the rise in treasury companies holding crypto, which you pointed to. Who would you say is the ideal investor in treasury companies versus ETFs? And does all this new attention on treasury companies take market share from ETFs?
I would say both product types have a lot of coexistence in the next few years. I think they're not exclusionary. They're not mutually exclusive. I think the way to look at it is the ETF world has an underlying demand for people who want that spot exposure without additional volatility or premium discount to NAV. Which is very important. I think that embeds a more infrastructural portion of the market structure for Bitcoin and other crypto assets. The corporate treasuries, I think, are more for sophisticated investors that want to embrace that added volatility coming from the added premium or discount to NAV at any given time. On top of that, I think it, especially for proof of stake networks like Ethereum or Solana, the corporate treasury model is especially interesting given that, they can stake 100% of it. So justifying that premium to NAV becomes more appealing.
Okay, that's all for Crypto World this week. We're back again on Monday, and we'll see you then.